So welcome to Weekly Tax Update, episode 112 for February 6th, 2026. A bunch of interesting things to talk about today, and I'm glad you could join us. I gave us a little bit of a football theme here, and interesting, the AI that put it together for me, I forgot to tell it don't call it the Super Bowl, but it knew on its own not to call it the Super Bowl. So we have our nice little episode 112 logo. If you're looking for me, you need to reach me, scan that QR code. It'll populate my data into your phone, and I'll be happy to interact with you however you need me. Give a call, go to the website. You can schedule a call. If you need help with a tax problem, we can help you with some research. If you need research often, we have a program that meets every week for 90 minutes year-round and actually meets for a total of 4.5 hours this time of year. You can come on, ask your questions. I even bring poor Rita Ryan in to help me with international classes on Wednesday. There are 3 open spots. If anybody wants to join into that group, shoot me an email and we'll be happy to help you out. All righty. So this was supposed to happen this week and it didn't. It will happen next week. We are moving this program to 4 p.m. To be honest with you, I need the extra time some days to get the content ready to make sure that it's current. So we have coaching programs ahead of this program. So we're going to move to 4. If you remember the first couple of years, it was at 5. So I'm not going to quite do that to you, but we're going to go to 4. All right. There's a meme going around to plug in, hey, ChatGPT, based on what you know about me, what do you think? This is what it thinks of me. I have more hair than that. Anyway, it did, and I don't know how it knows I like coffee. So we're still running into this problem that the IRS, now 3rd week in a row, has not updated the data on the status page that tells us how far behind they are on forms, where they are with other processing. I don't know what's going on. So I've deleted those slides for this week. We're going to check every week. And right now the numbers are through January 30th. So if we get numbers that are later than that, we're going to start sharing them with you. But as of right now, this is what we know. Nothing new. I will tell you, though, that power of attorney, 8821 and 2848s, we only submit 2848s here in the office. We track that submission. Mark Dombrowski and some other folks that are high volume submitters also track. Among other things, if you send in a bunch of stuff on Monday and 9 out of 10 get there on Thursday, by the following Monday, if that 10th one isn't there, go take a look at it. Did you not sign it? Something's wrong. So it's a good idea to track these things to make sure they're getting in there. And with the IRS the way it is these days, we are trying desperately to make less phone calls and do more things via automation online, or if we have to call, to make sure that if we get a good helper, a good assister, we are going to put up to our 5 full cases. Internal Revenue Manual allows 5 cases. Don't let them bully you. Tell them to check the Internal Revenue Manual. You always get that crap. My manager says I only need to do 2. My manager says I can only do 2. Your manager is violating the Internal Revenue Manual, probably violating the Taxpayer First Act and the Taxpayer Bill of Rights by not giving these people access to the representative access to their account. Used to be that worked. These days, I don't know, and you're going to see why. There's some folks now helping us on the phones that, you're going to get to, I don't know. All right. All right. So what are we going to talk about today? We're going to have a couple of local issues. We normally don't do local tax issues, but a couple of things came up that are going to expand into something broader. So I thought it was important that we talk about those things today. So IRS is back to work again. So we're going to talk about that. We're talking about the impact of the 2026 budget, high level stuff. I'm not going to put you to sleep. Section 224, no tax on tips. There's all sorts of stuff out there with regard to self-employed people. So I want to talk about that. Car loan interest, right? Proposed regulations dropped this week. So we've got a couple of better ideas on what to do. One of the hard parts about teaching this year, in addition to teaching, it's only a 4-year, some of these things are 4-year limited deductions. On top of that, we passed it in the middle of 2025, so you have transition guidance for 25, then 6, 7, 8, this is the way it'll be, and then it goes away. So it gets difficult to remember where we are on the track and what we should be talking about. So first big news, Tuesday, Congress passed funding, ended the government shutdown, and more likely than not, we're done with this until October when they have to figure out how they're going to fund next year's budget. Remember, it's a fiscal year, right? It runs October 1st to September 30th. In any normal government, they'd already be talking about next year's money. We're still deciding how to spend, how much we're going to spend for last year, even though you're 4 or 5 months into this year. It's a marvelous, marvelous process. All right, so what happened? The IRS got some bad news here. So first, I like some of these AI images that we've found now, where that reminds me of Only a Bill when I was a kid, right? Schoolhouse Rock, that image. Government shutdown concluded, and man, the IRS is getting the short end of the stick again. Don't get me wrong, they've got less people working there, but holy cow. So they funded $1.2 trillion in total. It passed by a very thin margin, 3 votes. And this ended the shutdown. $11.2 billion is going to the IRS for the fiscal year. But it comes with some caveats. So first, they further break down what we're spending where. They didn't say, here's $11.2 billion. Do the best you can. They said, well, we're going to tell you what to do. Because remember, Congress wants that phone answered. They don't care if it takes you 22 months to get your identity theft cleared, which is the last number we have. But they do care if the phone isn't going answered. And we talked last week about how screwy their calculation of a successful phone call is. Your business wouldn't work. That 70% number is really about a third. And either one of those numbers would be unacceptable in your own business. Half the IRS budget is going to enforcement, which I find interesting. The IRS is going to continue to prioritize compliance and collection. Taxpayer services and operations support are getting a good allocation, but I don't think they're getting enough. So $5 billion is going to enforcement activities, $3 billion to taxpayer services, answering the phone, opening the mail. Probably in there are the taxpayer liaisons, those folks that we talk to. They're probably buried in there, but I don't know. $3.2 billion for operations support. But they continue to chip away at that $80 billion. We got that $80 billion in 2021 as part of the Inflation Reduction Act. And the goal then Treasury Inspector Janet Yellen had said that taxpayers only interact with the IRS on like 9 of 60 of the ultimate forms and mission critical things they wanted us as practitioners and you as taxpayers to be able to do. So they said, we're going to do all these great things with $80 billion, except they don't got $80 billion anymore. So that was what they got in 2022. Already in other spending agreements, which isn't fair, they've taken back a little over $40 billion. And now we just took another $11.7 billion. Now, they'd already spent a bunch of the money, just like your client who gets that refund. And then when you tell them there's a mistake in the return, they're like, I already spent that money. So there's a lot less left over for them to use, right? If we took away 40 and we take away another 12 is 52 out of 80. We've spent 16 is 68. So that leaves us with about $12 billion. And if they don't spend that quickly, why do I think come October, that money is going to be on the table again to be taken away? Very disturbing report is circulating the internet from learned sources, right? Folks that generally would know better. So back in the days of COVID, when when we had problems, especially with ERTC money, then Commissioner Redding, who was going to go down as one of the greatest commissioners in the history of the IRS, simply because he walked into an agency that wasn't designed to work from home and wasn't equipped for the challenges of a shutdown. And he spent his 4 years defending what he inherited and making it forward enough that they could function during COVID. So great guy with what he was able to accomplish. So he had surge teams, right? If you remember, during COVID, they were like 30 or 35 days back on 2848 processing, and they were a year behind on processing ERTC claims. They quickly retrained people, and he sent a surge team. He took 700 people from less critical things and said, you got to go help them. And then all of a sudden they caught up on 2848. And for a while we had some craziness where I sent you stuff today and 2 days later it processed, yet stuff from 3 weeks ago hadn't processed. But that idea of taking people from other functions, giving them a quick training and saying, help the best you can, that seems to have worked. Well, what are they doing now? So they remained open during COVID by using some of the supplemental money out of the Inflation Reduction Act. But again, as we know, the Congress keeps taking that back, clawing it back from them. So they decided to take non-tax departments, things like human resources and IT. The only thing they know about the IRS is they work there, right? They've never done any other function there. They just work there. Federal government was hiring IT people. Oh yeah, I'll work here. They got stuck at IRS. Other folks, they were looking for HR people or taking HR people from within other government agencies. Yeah, it's the same GS code, same table of occupations and pay, and in bad, inappropriate things are inappropriate things, whether you're Sheldon Cooper or whether you're the a manager at the IRS. So we have all of these folks there who don't know a thing about taxes, don't have an accounting background, and don't need to. Well, they put these folks in the front line, especially answering phone calls and processing tax returns. Yeah. So what's that mean? We now are going to have operational risks. We already were correct answers on the phone lines were getting bad. It's like using an AI, a no-cost AI tool. If you knew what the answer kind of should be, and you could fight with it and say, no, I don't think that's quite it. I'm looking here. Maybe you should look there. But now just forget it, because you're going to have no idea whether someone is a 20-year employee working the phone desk or a 20-year employee in human resources. We've been encountering people as it is that answered the phone the first 3 years that they worked at the service and then have spent 10 years in exam or appeals, and they've been resourced to work the phone line. Just because you worked the phones a decade ago doesn't mean you know how to work them today, or it's just a completely different position. So this is going to increase the risk of inconsistent IRS correspondence. We're already getting strange letters. Somebody on one of our coaching calls today had a letter. She thought she was right, and she was right, that thank goodness took our advice, filed something certified mail right before the 3-year statute was up. IRS gets it in May of 2025. They denied the refund. Well, that's just wrong, because it was mailed timely. And that's probably driven by people not knowing their job or not being trained well enough to look at something and understand that the mail date is what counted, not the receipt date. We're going to see more and more and more of that. Now, on the one hand, if you're an EA, CPA, or an attorney, this might be good for you, right? Because there's going to be more work to do. But for any practitioner on the tax return side of things, boy, you're going to have to take a double look. My opinion, everything certified mail, everything in a 9x12 envelope. Everything in a 9x12 envelope, so that you can be sure that that scanned document doesn't get missed, because the IRS has automated what they call flats, number 10 envelopes in a big tray. That's automated, and they may miss the certified mail. So you definitely want to send it certified mail. We recommend in a 9x12 envelope. We also recommend you send electronic return receipt. It's $2.20 less. Good for you. And you'll be able to see it online for 7 years. We just looked this up. Section 7203 of the Internal Revenue Code puts the onus on the IRS. If I sent it certified mail, mailbox date applies. They got to prove they didn't get it. Trust me, this is what you want to do with anything you send to the IRS, and probably most of the states these days, especially as we convert to more and more digital processing. All right, so what can you do proactively here to manage the correspondence risk? You know, they got behind again by like 1 million items during the last shutdown, not the mini shutdown now, but the 45-day one before that, because if there's a deadline and I can't get anybody on the phone, well, I'm not going to ignore the deadline. I'm going to send it in certified mail, because if there's a penalty or a problem later, Exhibit A is you people were closed. Exhibit B is I still sent it in to you. So there was something that said if they processed another 20,000 documents a day, good luck. It would only take them a year to get caught back up. Bad news. So what do we want to do? They've got not the bad facts for us. Non-tax people are trying to help. And when we call, we've got to remember, people that work there are doing what they're told, and you want to believe people are trying their best. So I always take a deep breath, thank them for being there, ask them if they're having a nice day. And it doesn't hurt you to be nice to these people. They're in a very stressed position right now. If you work someplace, you're 2 or 3 years away from retirement, you don't really have the option to say, screw it, I'm leaving. So we're going to see even further processing delays, and sadly, there's no way around more errors. Just going to happen. We're going to see mistakes as they apply to tax law. Again, folks that just don't have the experience, even if they're trained, even if they know where to look, they're just not experienced. So that means more time to get stuff resolved and fixed, maybe more uses of taxpayer advocate. Are they going to get behind again? Maybe more uses of congressional inquiries. Are they going to get farther behind? Are they going to say no? I don't know. So, of course, more notices needing more correction. I'll tell you, just from what we see here on all of these rep cases, we're seeing more and more, we need 60 more days, we need 60 more days. It's almost rote that you're going to get we need 60 more days on a case. We've had some cases go out a year over stupidity. There's not a whole lot we can do. It's going to get worse. So one thought, a little bit beyond what we're doing today, but I used to laugh at Mark Dombrowski, because one of the things he does in his practice is your fee is X dollars for doing the work, always a flat fee. And then if it's longer than 60 days, whatever the service is, it's longer than so many days, we're gonna charge you a maintenance fee auto-drafted from your bank account. What's the maintenance fee for? Well, I'm going to get mail for you. I'm going to check your transcripts. I'm going to make phone calls for you. I have to get paid for that. So again, it's a flat fee. But these are things we should be starting to build into our practice. Wouldn't it be lovely if you didn't have to do the work and you didn't charge the person, you gave the money back? Set the expectations, so that you get paid for the work you need to do. Set realistic expectations for folks. We try to do that. Document anything with the IRS. I'm in the habit, when I speak to someone on the phone, sending them a fax or an email if I have their email address. Dear Revenue Officer Smith, great talking to you today for this update. Based on our call, I will do this by this date. You will do that by that date. Let me know if I misunderstand. Fax it over, email it over. Why? It gets into the examination file. I did this. You told me this. I did it. You didn't correct me, right? I hate retainer agreements, but in Mark's world, it works. And I think that's something we probably all should be doing. If you have TaxStone, if you have Stripe, auto charging your credit card is pretty straightforward. Auto credit card, debit card. So let's talk about no tax on tips. This is all over what I thought would be one of the easiest things, right? You got a tip, it's reported, don't tax it. Section 224, it's not that easy. I'm not going to talk about SSTB rules, but I am going to talk about self-employed rules, because this seems to be the confusion, the argument. Remember, the tax code is not designed to be fair. It's never going to be fair. It just is, right? So 224 is a huge change, because we've seen the slides I've sent you. If you want to see them again, you go look in part 1 of my tax update. I gave you a whole bunch of slides that show what percentage of the U.S. population receives tips and what the average tips are. And like you'd expect, the biggest receivers of tips are wait staff, people that work the coffee counter, people that wait on you, and anyone along those lines. Bartenders are a big one. So for these folks, this is a great deal. So starting in 2025 and running through 2028 as a review, you don't pay tax on tips if they are qualified tips for an occupation on the IRS list. So put aside, let's assume in these examples, I'm on the qualified list. I'm not an employee of a specified service, trade, or business. Tips must be included in a statement furnished to the individual. For self-employed people, that's the 1099 miscellaneous, NEC, or 1099-K. If this is on there, I can take no tax on tips. But what we're seeing is a bunch of different things here. Now, one common error we're seeing is not in favor of the taxpayer. Well, there's no box on the 1099-K or no box on the statement they received. Therefore, I'm not giving them this deduction. Guess what? For 2025, the guidance, they didn't change the forms. It was too late. So the guidance says if the tips are in there, if they're in that 1099, you can take the deduction. Now, in our practice, we want to see your report. If they're doing a side, one of the gig economy things, no problem. There's always a report to download. Give me that report and show me how much money that's already reported is a tip. Now, the qualified statement requirements is creating challenges. So that's challenge 1, is that the tax pro doesn't fully understand this. And that's okay. It's new. We want to help. But so the other trap for contractors is when the payers don't put the tips in the information return. We're aware of that. We're aware of a lot of people that do that. Now, there's a meme that floats around out there with Kermit the Frog drinking a tea. It says, so you want a deduction today for the tips that you haven't been reporting anyway, right? People don't understand how this works. And we're starting to find out that tips aren't in there. We saw one case where a person gets a W-2 and they get a 1099. Allegedly, those are the tips. Other times the tips aren't on the W-2. Well, you have to ask questions because maybe they're not qualifying tips. So we want to protect clients from losing the deduction, and we also don't want to give it to people who shouldn't get it. But in the past, we've notified everybody, the importance here. We need the documentation. In our practice, I guess we could take their word for it that it's how much is in that 1099. But let's face it, they looked it up to see what's in that 1099. Let me see that paper. Right? And we're keeping track by, we're being diligent here. We're recording conversations. We're keeping a copy of whatever they give us. I know I don't need to. I'm afraid when they're audited, they won't have it. I'm afraid that their story may change. Hey, this is what you had at the time. Had a fellow in here for no tax on overtime. He refused to go back to his employer and get the statement. This is why I don't miss doing returns in person. It's one of the few we do in person. And, he doesn't want to do it right. And it's like, I'm not going to let you make up the number, although it would catch him. But we ended up getting the information, but just prolongs things. We document, trust me, I documented this guy. If you have to follow up with people. In our practice, if people don't produce the documentation, we're going to say, listen, let's file the return the way it is. And later on, if you get that paperwork, we'll talk about amending it. You probably want to have a system in place to track these things. You want to remind people. And you want to think about how you're going to handle folks who don't respond. Today seems to be that tip day, not tips like Section 224, but the day that more comes in than goes out. Whole lot of stuff came into TaxDome. Surprisingly, a couple of people brought stuff in. A couple of people who left us showed back up this year, and I wanted to say, we're not taking new clients. What are you going to do? So what are some of the benefits of proactive implementation? Reduce stress, fewer last minute emergencies. I don't know. This place always seems like it runs should be. If we did a drama about this office, it would be called emergency, because that seems to be everything here, or last minute. I'm good at both. I cause last minutes, and we have plenty of emergencies coming to the door. All right. I don't know if there's really long-term practice benefits here, sadly, but this good system is going to keep us organized, keep the clients happy as best you can keep them happy. And we want to build trust and be a better practice than folks. So one of the things, though, that we're circling back to, though, is that they have to have that document that shows the tips were reported. So there we go. I was going to say I'm missing a slide. So for self-employed people, you have to have substantiation. It's got to be reported by a third party on the 1099. And then, of course, we want to see something that shows how much of that was tips. Now, they can't use a 4137. That's been the same guy, right? He thinks I want to pick up the phone. So if I'm a W-2 employee and I have unreported tips, I can file a form 4137. The guidance is very clear. I can report those tips as income, and then I can take the adjustment. Now, if I'm self-employed, I must have it on a reporting document that's very clear. No reporting document, no adjustment. In future years, there is going to be a tips box on the 1099K, and I think on the 1099 NEC. So, there's drafts of those forms out there if you want to go see them. All right, we said, so all income, including tips, belongs on Schedule C. But if the tips are not on a 1099, notice 2025-69 provides no relief. You don't get a deduction. You have to report the income, which you're supposed to have been doing over every year anyway, but you won't get the benefit of that deduction. The qualified statement requirement carries an all or nothing approach or proposition. Without proper reporting, contractors face full taxation on tip income with no offsetting deduction. So we had this conversation with some of our clients early on, and I just don't want to know what goes on, and we're already seeing pushback from some of the nail salons that alleging that that the right tips aren't on the W-2. Well, that might mean they didn't report the right tips to the employer, so they're welcome to do a 4137 and get benefit for that. All right, so I just want to see if anybody had any comments here. Nothing in the Q&A. Okay, so car loan interest. I'm only mentioning this because the regulations dropped, and there's an important tool that, if you weren't aware about it, I want to show you. So new car loan interest deduction is a significant opportunity for folks. Yeah, provided they just happen to have bought a car. Has to be a brand new car, not used. Must have had at least final assembly in the U.S., if not been fully built here. The loan has to be the first lien. The vehicle has to weigh less than 14,000 pounds. Has to be what the code calls a personal use automobile, car or light truck. And at the time you signed on the line that is dotted, thank you, Glenn Ross. When you signed on the line that is dotted, you had to have had more than 50% personal use when that note is issued. Okay, so you can verify the VINs online, and I think Samantha McGrath told me about this one. So you can go to the website right there, the Decoder website, nhtsa.gov/VIN for vehicle identification number /VIN decoder. And this will give you information you need. Now, without plugging in the VIN, you can look at the first digit. Most US ones start with a 1, although some start with a 4 or a 5. 70, 7F through 7Z. Why not just give us all of 7? I don't understand that. We should get the whole 7, right? 2 is Canada, 3 is Mexico, J is Japan. None of those are going to qualify for this deduction. You never knew you wanted to know this much about automobiles. So you can retain a VIN decoder printout in their substantiation. I mean, most of us are saving everything digitally anyway. So if you plug in the VIN and it comes back that it's US, just print it and save it. We do that with all sorts of things anyway. We're going to retain that for 3 years from the filing date for the return. You want to tell the client they should retain other things. How do you prove the loan? Well, the 1098 VLI, when it comes out next year, probably is going to show us that. But just in case, I would tell the client to keep the purchase documents, loan agreements, which they probably haven't kept anyway, threw them out on the way out the door. And then the statement that you get. No, I don't think anybody's seen a 1098 VLI this year. I think we've just seen lender statements, all of which are acceptable under the transitional guidance. All right. I don't know. This is just some more details of what I might do. But again, most of you are digital, are not paper full, right? And you're not printing these things out. So it should take a few minutes to document this. Do you need to? I don't know. I would. It's a good idea. And then, of course, next year, you got just like they tell you, Sally, same as last year, you got the same cars, same kids, same cars, same bank account. Cool. Move on. All right. Just stranger world we have. This is a $10,000 annual cap. If you're a single person, your income needs to be $100,000 or less. If you're married, $200,000 or less. Why they didn't make it $300,000 like all the other 4-year Trump deductions, I don't know. The deduction reduces $200 for every $1,000 over the threshold. So the number of $1,000 increases times $200 is the amount of the reduction. And I have two examples here. At $149,001, the entire deduction disappears for single people. At $249,001, the entire deduction disappears for married couples. If you do the math, $149,001 is 50 $1,000 increments. 50 times 200 is $10,000. So there goes your deduction. It will be completely phased out. Okay, so some loans are qualified, some are disqualified. I can just imagine getting these audits, right? So things that you're allowed to include, if they're in the loan, you're allowed to take the interest. Base vehicle purchase price, factory installed options, and then all those crazy dealer costs, the prep fee, the extended service plan, the extended warranty when it's financed with the first lien, sales tax, and title and registration fee. So all those things can be in that loan and no problem, deduct the whole thing. What's disqualified? Insurance premiums, standalone extended warranties, negative equity from a trade-in. So I have $10,000 left on my loan and I have a $9,000 credit for the car. I'm going to be underwater by $1,000. That's going to come off. Aftermarket accessories that I buy from the dealer, gap insurance, although can you buy gap insurance on a purchased vehicle? I know you can always get it for a leased vehicle. And then anything the dealer adds on, that Rusty Jones and paint protection and all that stuff, those costs would reduce the loan. So here's an example. I have a total loan of $50,000, but that includes a $6,000 carryover, negative equity, from my trade-in, but I put down a $4,000 down payment. So my qualified amount, what did I borrow? My qualified loan, I borrowed $50,000, but $6,000 of that is negative equity, gets me to $44,000. So if we argue that the down payment was applied to the negative equity, the calculation then becomes 50 minus 6 plus 4 to get me to $48,000 qualified. So review your loan documents carefully. I looked at the last car I bought back when Edsel Ford was still selling cars personally, the last new car I bought. And I don't know, you can look at the list. I don't think it matters because it all gets you down to amount financed. But understand that you want to track both the new cash and the negative equity. All right. So we're looking at those documents to see what's in there as well, the best we can. The 1098 VOI, we said, I haven't seen one. Lenders are not penalized for not filing a form they didn't know was going to exist until the middle of the year. 2026 forward, they will need to issue one or there'll be a penalty. And the reporting thresholds are $600. So people that have low interest loans, they may not get the 1098, and you may have to rely again on something that's printed. Okay, so they're not going to have these this year, but there are several ways that they can justify the interest, and these are ways that the dealership, not even the dealership, the manufacturers need to follow, the finance companies. So this was interesting, and there is a TIGTA study that I've included in the handouts on this. So let me just see no tax. There are questions on no tax on tips or social securities. A couple of interesting comments. Chase is sending out a letter with all the information: date of purchase, interest paid, VIN number. That is a nice thing that they're doing. Bill is right. When cars are used for business, you run a Carfax report so you can verify miles driven. Carfax is always good for a lot of these things, especially if you have the flat. Does Carfax charge a fee? It does, Katie, but I think that Bill is going to tell you that he buys the dealership plan for like $1,000 a year. He can run unlimited reports, which is kind of cool. All right. Rita asks, a self-employed dog walker, no 1099. Individual clients pay cash or check. Many give year-end tips, but without the 1099, he cannot deduct the tips. That is correct. That is the law. Now, if he was a smart fellow, instead of using his personal Venmo account, he would sign up for a Venmo for Business account and have everybody pay him in his Venmo for Business account. Then he would be able to get the deduction at year end, because for this year, it would have been included in the report. And I think for next year, he will get they would show it separately on the Venmo 1099. But again, you have to have Venmo for Business, not a personal Venmo account. Same thing with Zelle. Zelle does not issue 1099s because they probably correctly argue that they are not a financial institution. They're not, a third-party payment network. Hello, Katie. Katie in Arizona asks, hypothetical nail salon. Fee paid by credit card and reported on a 1099K. Tip is cash. Can you argue money is fungible? You know what? I wouldn't. And I'll tell you something. We have nail salons as clients, and I've been in plenty of them where you see the sign that says no tip on card. So, I think that you just lose the argument right there. I agree money is fungible, but these places are specifically saying not on the card. Now this year, you wouldn't know, right? Now, what I would say to you is, in my personal opinion, and we all know, how opinionated I am. Anybody working in a nail salon as an employee, the tips will be on their W-2, reported as tips, and they'll be able to get their deduction. Now, the owners, it's so interesting. I ask the owners, every one of them, if they have tips, and they all tell me no one pays tips to the owner, except this year, right? They all remembered they got tips. All right. Moving on. So I did a little bit of research just to round this out before everybody inundates us with, how do I do that for my client? So the IRS implemented new procedures back in January of 2025 to provide tax relief for Americans who are held captive abroad. Mostly following media reports that some of these folks had penalties and collections for not filing their returns, or they owed money and it became a lien or a levy because they were away. So you can't have that, right? And this was probably no fault of anyone's other than, oh no, I never thought of that, right? Well, the government thought of that. So there is now a code that appears on the transcript, HSTG. And this will make a deferral of liens and levies for 180 days after release. It'll go from now until 180 days after release. How does this work? So what does it give you? So it gives you a suspension of collection of the statute of limitations, penalty abatements for failure to file and failure to pay. I couldn't find out if they're automated, if they're automatic or not. You might have to ask for them. But everything I've read suggests the presence of that code. It just comes off. They won't revoke your passport during captivity. Yeah, wouldn't that be terrible? You get released, you can't get back in the country. And then again, that 180-day grace period afterwards. Now, this isn't automated. So it's kind of automated on one end, but not on the other. So I'll show you a slide in a minute. Depending on who's involved, the FBI and or the Department of State notify the IRS of what's going on and put this person on their list. That part is not automated, right? So once that happens, once the State Department verifies it, the IRS makes the manual input. They document the release date subsequent when that happens, and they work with someone at the Taxpayer Advocate Service to make sure these counts are correctly flagged. So there's an interagency memorandum of understanding, an MOU, with the IRS, the Department of State, and the FBI. It's so amazing how they can work when they need to. So these things finalized October of 2024 with the State Department, February of 2025 with the FBI. Those two agencies will provide names, social security number, and detention dates within 30 days of them officially becoming declared a hostage overseas by the U.S. government. They're going to have some sort of list semi-annually, I guess, so that they can reconcile, right? I got this guy on here. Oh, I don't, right? And you make sure that the lists match so that nobody falls through the cracks, which is how this started. And then everybody gets that HSTG in the IRS IDRS system, and that'll protect them from collections. Let me see this one. Oh, nope. I thought I had one more slide that they were out of order. So what happened is, how did this happen? The TIGTA report talks about the program failures. So it's been running for a little over a year. So first they had incorrect labeling. Now, they don't tell you how many of these folks are in the universe, right? So 75 individuals, while anybody not being correctly labeled is a concern, is that, 500 people or 10,000 people, right? 75 individuals were incorrectly labeled, blocking legitimate tax returns and refunds. Oh, that's interesting. These false positives caused hardship. Sure, it's like being labeled identity theft. You got my tax return, you don't do anything with it. Some genuinely released hostages did not receive the penalty abatement despite the coding. Manual processing failures meant the automatic relief provisions didn't work. And then, of course, there was the interest issue. Current law prevents the IRS from abating interest for captives. It's going to continue to accrue during the detention. Maybe that was an oversight. Maybe they didn't think about it. I bet you that that's going to be tagged onto something coming up. The IRS can't abate interest, so you'd still have to deal with that. But they'll figure that out. They'll make it law that it'll automatically abate. So there is proposed legislation, the American Hostages Act. I wish they had a better name. Congressional action that wants to address the limitations of some of the administrative relief provisions. So in the Senate, it's Bill 655, introduced last year to stop all penalties and interest. The IRS is not currently required by statute to provide relief. Right? It's just for the administrative of lien levy collection. The proposal would be for complete abatement. It would be mandatory, not discretionary, right? Objective, not subjective. It'll extend the statute of limitations, though. Terrible. And they're going to simplify the certification process just through the State Department. I thought I had a slide here on it, and that's what I was looking for a minute ago. So what's interesting is that some of these things come through the FBI and some come through the State Department. So the ones that come through the State Department discusses with the family. It came up early that sometimes the family doesn't want it known that their family member owes the IRS. So it's very strange because I would think you would want this relief. Some people don't. There's an opt-out provision. The FBI has said publicly, we have no way to do that. We have no way of knowing, so we have to share with the IRS anything we know. So maybe that's something else they want to clean up, make work better. So I wanted to stick this in here, and this is going to become a class because I thought this was on the Tax Foundation website. So remote work has always been a concern, right? Especially with New York State, where New York says if it's a New York job, they don't care where you're doing it. It's New York income. So as of January 1st, there are 22 states that require a non-resident return if you have a single day of work within their borders. Remember, income is sourced to where the service is provided. So 22 states, 1 day. $160 average cost to have these non-resident returns prepared. Yeah, that's great for me. But this burden, of course, multiplies for folks who work in multiple states. This is a bad example that a sales rep visiting 5 states could face obligations in 60 different jurisdictions if you look at some of these cities that have a tax. But what they're not reminding you is there's a public law and Wrigley versus Wisconsin, which state, it's public law 86-272, which state that if an employee goes into a state merely to take a sales order, but they can't be able to approve it. I just take the order. I'm not going to trigger nexus for myself or my employer to that state. Now, the Wrigley case was interesting because Wrigley Gum in Illinois they had salesman. Salesman goes out, he has a pad, he looks at what you have on the shelf, he takes an order. If some of the gum was old, was stale, or even if the merchant complained, the guy had a couple of cases of gum in the car, he could swap out your stock. He would also occasionally, if you were, a little slow in your payments, he'd ask for a payment. Well, hey, while I'm here, can I have a check? Well, those two things, of course, said that you're not just merely here to take a sales order. You're acting as an agent. Acting as an agent triggers nexus. So Wrigley versus Wisconsin. That used to mean a whole lot back when I did a whole lot more state and local tax work. So I put this image in as a PDF for you because it's kind of neat to look at it, stick it on your desk. I don't know, put it up on the wall if you have people that come in the office. Put it up on the wall for clients who are like, oh, I don't want to file in that state. Here you go. This is fun stuff that you find when you're looking for something else. That wasn't even a ChatGPT item. That was a real thing that we found. So list of these 22 states, if you want to have fun. A couple of states have filing reforms coming out. So if this affects your clients, you might want to put it down somewhere. I always advocate that you check this every year. I mean, we don't have enough to do with tax update. Really, I'm going to go check on Alabama for the 2 Alabama returns I do. But these reforms might be important for accurate multi-state planning. So Louisiana wants to increase their threshold to 30 days of in-state work. Alabama adopted a 30-day threshold but added a mutuality agreement. So that creates a mixed outcome for folks. We'll talk about mutuality in a minute. Minnesota increased their threshold to $15,300, and then they're going to index it for inflation moving forward. Some of this stuff is tough. You might remember that as great as Governor Emmy Award was here in New York, Governor Cuomo, one of the things he wouldn't budge on was the folks who came and worked on the medical ships here when they were docked here, and they had to file New York returns for working here for 2 weeks. And he was pretty clear. He said, it's not fair, right? We're making all these other people pay. You have to pay too, you know. All right, what's mutuality? So this is a complex aspect in multi-state taxation and tax planning. Basically, you have to have a substantially similar exclusion to residents working in the work state. So a Colorado resident, where there's no threshold, works 1 day in Utah, which has a 20-day threshold. He has to file in Utah on the first day because Colorado lacks reciprocal mutuality, right? In other words, they don't have the same 20-day exclusion. This needs to become a class, by the way, just as I went through some of this, starting out with that stupid map, right? And I came to all of these things. So we're going to do something. So unrelated to this, I get at least a phone call or two every year from somebody who has a problem such as New York City wants my client, doesn't understand my client's an S Corp, and they're billing them for tax. That's correct. You're a C Corp in New York City. New York City does not recognize the S election. I also get calls. My client doesn't live in New York City, but their business is there. Their sole proprietorship is there. New York City billed them for $4,000. How do I explain to them they're not a resident? And the answer is New York City has a business tax for unincorporated businesses, whether you live there or not. So in looking around, a couple of things came up. So the city of Los Angeles has a business tax. It's effective March 2nd. If you were there for 7 or more days, have 4 or more transactions. So if I have a remote worker in the city, but not the county of Los Angeles, if you ever remember Dragnet, by and for the county of Los Angeles, the city business tax was going to apply to businesses conducting activities there. Threshold is low. No cheating. So understanding how remote workers create nexus is important. We've talked about this with respect to states. Now we have this with respect to cities. Employers with remote workers residing in the city are subject to LACBT, even if the employer has no physical presence in California. Well, technically they do, the employer's home office, yeah. Now, we found this out the hard way, especially during COVID. You know, when people moved and didn't tell their employer, or, you know, the W-2 got lost, so then they told the employer, oh, I moved from this state to that state. What? Yeah. So you get that surprise nexus connection. A colleague in our coaching group already didn't want to have California clients or California workers because of this. And she added, well, I'm not going to have any Los Angeles workers either. And I said, well, thank goodness you've already banned California. Okay. The tax is actually fair. You're going to allocate gross receipts to Los Angeles. Depending on your type of business, you might pay a different rate. Minimum tax can be $100. Maximum tax caps only for certain industries. When you see how big the numbers are, you'll scream. So this is similar to what New York State does. Los Angeles, as part of opening up their tax, said, and we're going to have a voluntary disclosure program for all the people that miss it. They're going to look back 6 years. So you have to be filed 6 years as part of the process of asking for a waiver. And then the maximum penalty, underpayment penalty, is 40% after 4 months. So that's a lot of savings to be able to do a voluntary disclosure. I'm not going to put you to sleep here, but penalty structure is available. San Francisco, Proposition M for money. November of 2024 fundamentally restructured the city's business tax starting last year, 2025. So what happens? Annual registration fee due from March 2nd, 2026. It's at least $59, as high as $60,004, based on San Francisco's gross receipts within the city. Now, there's the thing about executive compensation. When you see how big those numbers are, you don't need to worry about it. So what's the registration fee? Up to $1 million, you pay $59. 1 to 2.5 million, $350. $2.5 to $25 million, $1,000 at any of those levels. I don't see any of those things being a hardship. I'm going to skip the overpaid executive tax because I think you have to be over like $50 million in sales. And there's also this ratio tax on the comparison of how much the boss makes, the executives make, to the rank and file folks. Oh, there was an exemption. If you have 1,000 or less U.S. employees and $1 billion or less in gross receipts, that's most of my clients. San Francisco also has a homelessness tax and a commercial rent tax. The homeless tax, I don't think they tax the homeless. I think this is like Portland. This tax is designed to fund the homeless initiatives. So if you have 25 million or more in gross receipts, you're going to pay this tax. There's a commercial rents tax, 3.5% on commercial rent paid, lower at 1% for the warehouse space. The tenant pays this tax, and it existed before and has not been modified. This is similar to the New York City commercial rent tax. I just want to mention this because your clients may come in and talk about it, and I think it's important that we don't look like complete knuckleheads. So President Trump has filed suit against the IRS looking for $10 billion. That's $10 billion with a B. So there was a leak that WikiLeaks, you might remember that ProPublica got a hold of a whole bunch of IRS records, including the fact that the founder of PayPal, Peter Thiel, has $5 billion with a B dollars in his Roth IRA. Well, he could fund the president, half the president's lawsuit. So where's this coming from? There was an unauthorized leak of tax return information by IRS contractor Charles Littlejohn. He obtained this stuff and he gave, I think he gave it all to ProPublica. And of course, he lost his job over this and he went to prison because it's unlawful disclosure of information. So President Trump, Donald Jr., Eric Trump, Trump Organization, LLC, are all seeking damages. $10 billion in statutory and punitive. I hope they told him that punitive damages are generally taxed. And actual damages that were sustained, whichever is the greater. Section 7431 provides a statutory foundation for the lawsuit, establishing a private citizen's right of action when there's an unauthorized disclosure of tax return information. And that can include all of his costs as well. So this thing in theory could get pretty expensive for the federal government, and they'll probably fight it. So this is going to test the scope of damages available. Certainly they have inadequate taxpayer privacy protections, but all sorts of people were outed here. I mean, Mr. Thiel was outed. Warren Buffett and his number two, I think Mr. Jain, who's now the president, Jain, who's now the president of Berkshire Hathaway. And Mr. Buffett didn't return phone calls, but I remember this. So because Buffett has like $200 million in his IRA, Roth IRA, and Mr. Jain had like $100 million. And what's funny is that he said to the reporter, "You're forgetting the part that I paid tax on $50 million of it in 1997 and 1998, whatever the years were, right? That you were allowed 2 years, regardless of income. You could pay half this year, half next year. Apparently, that's what a lot of these folks did. You know, so they left that part out that he paid tax on. It's not like he has this magic amount of money he's never paid tax on. Anyway, so Mr. Littlejohn worked for Booz Allen Hamilton, which is a management contracting company. So as part of this, they just lost their contract with the federal government. They had to have seen this one coming because, I mean, this has been a couple of years since Mr. Littlejohn did this. So all the contractors now are going to face enhanced security scrutiny. And like we said, Littlejohn went to prison over this. So now we're worried. What's this going to do at the IRS technology modernization programs? So is that going to further delay getting the program done? Is that going to further create further delays in responses on technical issues while they transition to another management company? And then, of course, are these changed e-file protocols going to affect us, either through the portal or through e-file? I don't know how much stronger these things can get. All right. Super cool. The real estate industry has asked for some guidance related to interest deduction elections under TCJA. So some of those elections are irrevocable, but now they're arguing they should have retroactive withdrawal rights. So 163J elections were irrevocable. So once you wanted to, once you elected to be able to make the interest deduction, you lose some of the capital spending deductions that were available under the new legislation, right? So the ability to take a bonus depreciation, for example, that's back. So firms are asking Treasury to allow them to withdraw the elections so that they can better use the new 2025 OBA breaks. So if they get this and they can elect back out of 163J, they would be able to take immediate expensing again of deductions. So the question becomes, that's being debated, does Treasury alone have the authority to do this administratively, or are they going to overstep their bounds and do they need Congress to do it? Right? So Congress would have to modify the tax law. You'd have to take a look at the Byrd rule. Are we creating relief that's going to last more than 10 years? Do we need to have an offsetting tax to make this work? So it's something we're going to watch as a planning move. Why this ended up here, this is the wrong spot. So this was a table back when we were talking about tips in 224 about the compliance, whether you had a 1099, had no 1099. So I'm not going to bother you with that. But here were my examples. So I'll do these quickly. So independent contractor receives $40,000 in fees, $8,000 in tips. The tips are not on the 1099 NEC. They should have been. So my gross income is $48,000 because I'm an honest taxpayer. I'm not going to get a deduction this year because it's not on a qualified tax reporting statement. I would sue my former employer, my former payer. So independent contractor B receives $40,000 in fees, $8,000 in tips, but a $48,000 1099 NEC. My gross income is $48,000. I can take the $8,000 and I pay tax on $40,000, right? Well, actually, it's the $8,000 is after the standard deduction or itemized deduction, but you get what the net effect is here, and that would have been a better way to word this: is what's the net impact? What am I going to pay income tax on? Now I still pay Social Security on the whole thing, right? So, all right. Yeah, these things moved on me. Sorry. Here's an example of the phase out on the car loan interest. At 220,000, I phase out at 250. So there are 20 thousands, and so I'm going to lose half and only be able to deduct $4,000 of the $8,000 car loan interest. So every single person, we sent out emails telling people they bought a new car to bring in the information with us. Every single one that answered yes to the new car question did not provide interest yet for me. Every one of them. I'm like, you're not smart enough to have a car loan if you can't bring this in for me. I would proactively contact 1099 tip earning people. Explain, if you haven't already done it, explain how this works and make sure they're going to be able to bring you in some paperwork. Right. As a reminder, next week, I'm moving to 4 o'clock. 4 o'clock Eastern time. We should have said that up top, Eastern time, right? And I have more hair than that. I'm sorry. But we'll see you next week on the 13th at, on the 13th at 4 p.m. If you have any questions during the week, by all means, I'm here working. Send me an email, give me a call. There's at least one more question. I will take the last question from Ben. What are your thoughts on the QR code on the CP2000 notice letter for responding to the CP2000 with requested documents? I still like sending stuff in certified mail. So if I were doing this via the QR code, you do get that, confirmation that it went there. I think I would probably give it 15 days and maybe for the first 5 or 10 of them, call in and make sure that it's in their system. In other words, enough time that they should have waited, enough time that they should have processed it, and then enough time that if it's not, I can still get it in the mail, So I think sadly, this is the future. I think that you're going to see less QR codes for us, and you're going to see the ability for us to just go into our portal. Once the power of attorney populates, you'll see like that little red flag, that little yellow dot that says Susie Smith has an outstanding notice. I'll pop it open. I'll put in the stuff. And then, if you want to go back with me almost 30 years, Mark and I had this conversation. We both piloted something called CASL, C-A-S-L, in the Philadelphia Service Center piloted, which it was secure messaging for resolution of notices if you had a power of attorney on file. So, the IRS has been here before, but with less people and wanting to spend less money, they're going to have to make these systems work. Hopefully TIGTA is watching, and TIGTA will let us know in a year how well they're working. But like I said, I would give it a try. Trust but verify, and once we're sure that these things are working well, that's probably no problem. And I would just start doing them on a regular basis, provided you're getting some sort of verification that you popped it up there. All right. Thank you all for joining us. I really appreciate it. And have a great weekend.